Good afternoon, ladies and gentlemen, and welcome to the US Solar Fund PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll. If you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the team from the US Solar Fund PLC. Meredith, good afternoon.
Good afternoon, everyone, and welcome to the 2025 Interim Results Presentation for the US Solar Fund PLC. I'm Meredith Frost, Investor Relations Lead for the US Solar Fund here at Amber Infrastructure. Joining me today is Tom O'Shaughnessy, Amber's Head of North America, John Toolings, the USF Head of Asset Management, and Dan Watson, Amber's Head of Sustainability. Tom, John, Dan, and I will be available to take live questions at the conclusion of the presentation, so please submit these throughout. Please note that the presentation we refer to today, the interim report, supporting information, and associated RNSs are all available on the company's website, ussolarfund.co.uk. I'll now hand over to Tom to take us through the detail.
Thank you, Meredith. And hi, everyone, and welcome from me to the results presentation for the US Solar Fund for the 6 months ending 30th of June 2025. My name is Tom O'Shaughnessy. I'm the Head of North America for Amber Infrastructure, and Amber Infrastructure Investment Advisor LLC is the appointed manager of the US Solar Fund. So you'll hear me refer to the US Solar Fund throughout this presentation using the abbreviation USF and Amber Infrastructure Investment Advisor LLC as Amber. Now, similar to prior presentations, what I'm going to aim to do here for you all today is provide an overview of the results, but then dive deeper into additional information on key topics. I'm joined today by John Toolings, our Head of Asset Management. John has been with this portfolio since IPO and leads a team who are responsible for overseeing the operations of these assets. And John's here today to assist me in explaining some of the operational aspects of this set of results. Now, I'll start by reminding everyone of the key features of the USF portfolio. What we have here is a portfolio of established operational solar assets. The amount of electricity generated by those assets varies slightly due to weather and due to operational outages, but overall the portfolio presents a very stable cash flow profile over the next 30-some years. The contracts under which these assets currently earn revenues are also simple and easy to analyse. And when these contracts expire, the company will look to enter into new arrangements in deep and well-supported markets. And it's this that provides USF with some exposure to the outlook for the US energy markets. Given recent changes in the US energy markets, that's going to therefore be a feature of today's presentation. So hitting first on some of the financial metrics for the past 6 months. The net asset value of the fund has increased to 65 cents a share as of June 30th, 2025, and that's an increase from 63 cents per share at December 31st, 2024. The total net asset value has increased to $200.5 million. Based on the dividend target for the next 12 months and the share price as of the 12th of September, the fund would yield 8.2%. From an IFRS perspective, the company generated a $9.8 million gain in the period. The gross asset value per megawatt installed remains around $750,000 a megawatt. Now, this metric describes the value of the portfolio on a per megawatt basis, and it was introduced in 2024 in the full year results in order to provide shareholders with a quick reference, a means of comparison across portfolios in the sector and to new build solar. We continue to see new build solar at approximately $1 million a megawatt. From an operational perspective, the average counterparty credit strength remained the same at BBB+. Leverage at the 30th of June was around 39% of the total gross asset value, and that follows the refinancing that occurred during the period. The weighted average length of contracted offtake agreement fell during the period from 10.9 years to 10.4 years. Now that's as would be expected given the passage of time and the fact that no new contracts were entered into during the period. The vast majority of the portfolio revenues are fully contracted under long-term fixed power price agreements over the next 10 years. However, as the average tenor of those agreements reduces, the company has more and more exposure to the long-term outlook for power demand in the US. Touching briefly on some of the performance and environmental highlights, during the 6 months to date, the portfolio produced nearly 350 gigawatt hours of electricity. The portfolio generated sufficient electricity to offset the CO2 produced by 53,500 cars and to power the equivalent of 33,800 homes. Now, again, as per previous presentations, we've sought to highlight the key messages that are relevant to the performance of the fund in this period. The key messages that I'm going to talk about here today are, firstly, the US energy market. Now, we've witnessed a period of rapid and seismic change in the US energy markets, ushered in by the new Republican administration. The headlines related to renewable energy that have resulted from the changes in policy implemented by the new administration are obviously alarming. And one of my jobs here today is to explain what does and what does not have an impact on the outlook for the USF portfolio. The second area that we're going to focus on is operational performance. Operational performance will always be an area of focus for these presentations. However, as we continue to remediate the portfolio, it's critical to explain in quite some detail why we've seen underperformance, whether we see that underperformance repeating in future periods, and where we do, for how long shareholders should expect to see underperformance. Finally, I'm going to talk to the strategy and outlook for the company. This is of particular importance in this set of results, as the large change in market conditions coming from federal policy changes here in the US potentially leads to a different set of opportunities for the USF portfolio of assets compared to the last set of results. So what have we done since we last spoke? Well, we completed a full refinance of the company's senior debt during the period. This refinance removed any near-term risk related to the senior debt of USF and ensures that the company's balance sheet is not exposed to volatility in the financial markets over the next 5 years. On the 17th of April, the board issued updated guidance around the dividend target, increasing the dividend per share to 3.5 cents. This increase was possible due to the refinancing, which reduced near-term amortization and freed up additional cash flow that could flow to shareholders. Lastly, we've meaningfully progressed the remediation plan. Further to the diagnostic work that we undertook, the remediation plan has been implemented across a substantial portion of the assets, including the very recently completed capital works undertaken at Granger and Valley Centre. These projects represent just under 7 megawatts of the roughly 40 megawatts of assets that were identified as requiring either capital investment or more intensive remediation across the portfolio. In addition to talking about the plans for the remaining 33 megawatts of assets, John will be talking about the outlook for sites that have already been remediated and performance-enhancing measures that we're taking as part of the proactive maintenance plan in order to keep those assets performing at the highest possible level. So moving now to talk about one of the most potentially impactful changes that has occurred during the period, and that is the overall outlook for the US renewables market given changes in federal policy. During the last 6 months, the new Trump administration has taken multiple steps to firmly entrench changes to federal energy, trade, and industrial policy. These changes have had a significant impact on the outlook for US energy markets, as the US federal government has aggressively moved away from the previous subsidy-led model that stimulated private sector development of renewable energy generation assets. The Unleashing American Energy Executive Order, signed on the 20th of January, laid the groundwork for these changes and showed a clear vision for a greater proportion of US energy being provided by non-renewable fuel than the previous administration. The subsequent passage of the One Big Beautiful Bill into law, along with other recent presidential executive orders, have narrowed, amended and repealed tax credits and other supportive policies for new solar and wind development. Now, the industry is still grappling with the changes and how this will impact the US's ability to meet its rapidly increasing demand for electricity. However, what is clear already is that this represents a significant shift in policy for renewable energy developers and has, at a minimum, the potential to significantly impact the number of new renewable energy projects that will be supplying electricity to the US grid over the medium term. Now, for USF, it's important to immediately state that none of the changes made under the various legislation passed by the administration is being applied retrospectively. Therefore, nothing that we've seen included in the One Big Beautiful Bill or any of the executive orders is believed to directly negatively impact the USF portfolio or its ability to generate electricity or revenues under its current contracts. The removal of tax credits and the removal of other supportive policies applies really only to new projects, those that are yet to begin producing electricity. And as an operational portfolio, USF is not impacted by the limitations applied to tax credits or the changes to permitted reforms. Conversely, we've consistently stated that policies that reduce or restrict renewable generation could lead to increases in prices for renewable energy and indeed all forms of energy, and therefore this could benefit operational assets like the USF portfolio. Given that the significant changes made to federal policy have been enacted, and we've not yet seen how these have fed into long-term forecasts for energy and energy prices that are provided by the handful of specialist advisors that provide such forecasts, we're waiting to see what the impact will be and what the interpretation will be of these changes to long-term power prices. But all things being equal, a reduction in the amount of generation capacity forecast to come online should increase prices. Increasing demand without a commensurate increase in new generation would also drive prices up, and that's something else that we're seeing in the US energy space. We'd expect to see the impact of these seismic changes to US energy policy incorporated into forecasts for energy prices during the second half of 2025, and therefore would be included in the full year 2025 USF results. Now, I'll quickly note that Amber, the manager, has recently issued a white paper discussing some of the policy changes in more detail, and that's available on our website. So with the key message that USF is not thought to be directly negatively impacted and could potentially benefit from the changes in US federal policy, I'll move on to talk to the financial and operational performance of the portfolio. But first, I would like to pause for a second here and just try and describe in high-level terms a link that we are observing between the general volatility in the renewables sector and perhaps macro environment in general and the performance of the USF portfolio. Now, we've seen a deterioration in the performance of the portfolio over the first 6 months of the year. As John will talk to shortly, some of that underperformance relates to known issues that we've highlighted in past reporting periods, that specialist advisors have reviewed and that we're addressing or seeking to address. However, some of the underperformance comes from new issues. Multiple grid-related outages due to concerns around wildfires and other extreme weather events have impacted the portfolio in this period. Theft of copper, due, we believe, to a rapid increase in copper prices, has impacted the portfolio in the period. And delays in receiving equipment due to supply chain dysfunction and general poor customer service has impacted the portfolio in the current period. And these are all new factors, things that we haven't necessarily seen before. I raise this because these issues are not unique to USF, but are increasingly a feature of US and possibly global generation, transmission and distribution systems. As demand for electricity grows and new stress is added into the system, we're seeing new stress-related issues emerge. Whilst it's too early to say whether these will need to be priced into future forecasts for all projects, we're certainly not naive to these threats. So we're currently monitoring and trying to actively manage these new challenges. Our belief is that if things like theft, outages, and uncertainty in sourcing of key components continues, prices across the entire energy sector will need to increase to offset the cost to owners of addressing these problems. Our goal and strategy, if this scenario bears out, is to get out in front of these issues, mitigate them as best we can, and then seek to benefit from the higher energy prices that all asset owners will demand due to general increase in costs. So with that said, I'll turn to net asset value movements during the period. Firstly, the dividends paid in the period reduced the net asset value by 3.5 million from the 194.2 million net asset value at the end of 2024. The dividends paid were offset by income received during the period of 4.4 million, represented in the final bar of this chart. There were small reductions to property tax schedules, some changes to inflation and deposit rate assumptions during the period that in aggregate led to an approximately $0.7 million increase in NAV. Changes to the merchant curves used to forecast future energy prices for the current period actually reduced slightly in the first half of the year. These were, of course, not impacted by the recent changes to federal policy that were implemented in July. Discount rates reduced in the period from 10.8% to 10.5%. This was driven by a small reduction in base rates and a reduction in the asset-specific risk premium. The movement in the asset-specific risk premium reflected the de-risking impact of the refinancing that was undertaken earlier in the year and changes in the wider market comparables used to derive the appropriate discount rate. In total, the NAV during the period increased by 3.2%. Digging a little deeper into those discount rate movements, the movement in base rates of 10 basis points and movement in asset-specific risk premium of 20 basis points comprised a total movement of 30 basis points in the period. USF retains KPMG to perform an independent valuation of the company and its portfolio. A quick note on dividend cover. Operational dividend cover for the period was 1.05 times, impacted by that underperformance. In 2023, this was 0.5 times. The operational dividend coverage metric seeks to reflect the sustainability of the level of dividends payable by looking at underlying cash generation from the portfolio, excluding significant one-off costs and incomes not expected to be recurring in nature. So now, as we turn to another key topic, operational performance, I'll bring in John to discuss aspects of the performance and the remediation plan in greater detail. But before I do that, I wanted to revisit the long-term trend charts that we introduced into the reporting this time last year. Now, the first chart shows the long-term weather variance compared to forecasts. Just as a reminder for everyone here, underperformance demonstrates really overly aggressive assumptions related to the solar resources, the amount of sun we expect, whereas overperformance indicates more conservative assumptions. What we therefore want to see and would expect to see for any solar array or portfolio solar arrays is to see around 5% variance around the mean and a long-term average that meets the forecasts. Now, in the current period, we saw 0.6% overperformance versus the forecasts, and therefore a slight movement in the average towards parity. This was encouraging after a relatively poor irradiance year in 2024. The positive variance and improvement in the average, which is not materially different from the long-range forecast irradiance, indicates that the forecasts made across the entire USF portfolio are, on a whole, accurate. The second chart here shows the long-term performance based on non-weather related variables. This basically shows the amount of outages the portfolio sustained over these periods. And in the last 6 months, the portfolio underperformed by 10.8%. Now, there's a number of reasons for the underperformance, and in the current period, these are quite nuanced. We have, as a result, included considerable additional information in the interim report to describe, explain, and quantify the underperformance, ultimately looking to explain the trend in this bottom chart and how we see that continuing. Ultimately, what we're seeking to do is guide investors around whether or not we would expect to see the portfolio continue to underperform in terms of outages in future periods or not. So I'll turn it over at this juncture to John, who will walk through the portfolio performance in the period.
Thanks, Tom. As Tom stated, the performance of the portfolio for non-weather related factors was negative 10.8% in the 6 months to June 30th. A significant proportion of that underperformance is related to some themes that we haven't seen across the USF portfolio. I'll talk to these first and then move on to talk about my team's efforts on the remediation plans over the last 6 months. A new issue that we have encountered during the period in which we haven't experienced before across the USF portfolio is theft-related outages. In the last 6 months, theft of copper at a number of our North Carolina assets has contributed 1.2% to the overall underperformance in the period. Historically, theft and vandalism has basically been non-existent. That is a different story now. We have had 4 sites that were heavily impacted by theft. We believe this increase in theft may be motivated by higher copper prices that have increased significantly over the last few years. We also know that other projects in North Carolina have been facing similar issues. Theft requires a lot of time and resources from our operations and maintenance and investment manager to prevent, deter, and remediate. For example, we have installed 24/7 in-house camera monitoring platform to alert the police of any unrecognized site activity which has already shown its worth in a few instances. We have worked with other asset owners on conjoined efforts, and we talk to and support the local police departments regularly. The good news here is that the majority of theft-related costs resulting from this damage, rectification, as well as lost revenue is insured. However, for safety and in order to prevent these types of outages happening in the future, we will continue to work with law enforcement and neighboring affected site owners on practical deterrent strategies. The second new issue that we are experiencing is grid-related outages. Grid outages are instances where we have been told to stop generating due to safety or other issues on the local grid network. Historically, grid outages haven't been a significant reason for underperformance. However, in the last 12 months, we have seen an increase in grid outages, and in the current period, these led to 1.62% of underperformance. There are many reasons for grid outages, but some of these are extreme weather events, including wildfires. The reasons for grid outages is something that we are looking into and analyzing in greater detail in case we continue to incur significant outages related to the actions of the grid operator. Ultimately, there's generally little that can be done to mitigate a grid-related issue, but our ability to collaborate with other projects and project owners, understand the reasons for the outages, and seek to influence the grid operator where possible would lead to lower grid-related outages in the future. It's worth me mentioning that at this time, we have not adjusted our long-term forecast to account for increased grid-related outages, but will continue to monitor closely the average level of the outage in the coming periods. I'll now turn to the impact of our remediation plan. The remediation plan that we have implemented is intended to address the frequent, low-impact, unscheduled outages. In the current period, these issues led to 5.8% underperformance. The biggest contributor was inverter outages, which alone led to 3.6% of the underperformance. Issues like these come down to the reliability and diversification of the components we are using across the portfolio. In the current reporting period, we've provided additional information on the portfolio in relation to the components that we use. The solution to these problems, put simply, is to get people out and fix them as quickly as possible and give them the parts required to repair the assets. We have made great strides in both regards, and building up spare part inventory has already proved valuable in the first half of 2025. Some of the spare parts procured last year went right to work to repair inverter outages rather than wait for our OEMs. As part of the West Hines elected transformer outage, we were finally able to procure a spare transformer, which is a key reliability asset across the Urial's fleet. Throughout the rest of the year, we are taking receipt of ordered spare inventory parts, strategizing tracker and module parts, and doing a full medium voltage strategy review. USF will benefit from this initiative for the duration of the useful life. 2% of the underperformance is related to the capital initiatives that our team is working on. Capital initiatives relate to instances where we know capital investment is required to improve performance. During the diagnostics phase, we identified 7 projects totaling around 40 megawatts that fell into this category. During this period, the 2 most critical projects, Granger and Valley Center, were being worked on, and I'm now pleased to report are basically complete. We are already seeing an uptick in performance from these projects as a result. The details of the capital initiatives are shown on slide 18. The next project is Chiloquin, of which we are nearing contract execution to get that scope going. This is a 14 megawatt project that will take around 6 months to remediate. Phase-on will be shortly thereafter Chiloquin, as we are just wrapping up the financial analysis of the cost to do this scope. However, it looks now lucrative. I'll be available at the end of the presentation to answer any specific questions that you all might have in relation to the detail of the remediation plans and ongoing work. For now, I'll state that I continue to have a positive outlook on reducing underperformance. The right initiatives are in place while the proper preventative maintenance and corrective maintenance is being done. It is going to continue to require a lot of work from everyone involved, but we know the issues and have been actively working on these. The main unknown at this point is whether there will be new issues that arise, such as theft, grid outages, poor OEM performance, or delays in accessing parts that lead to continued underperformance across the portfolio. We've made significant strides over the last 18 months, and expect that our actions and the actions taken over the next 6 to 12 months will lead to an improvement in the long-term performance of the fund. We look forward to demonstrating this to shareholders as we bank strong performance across the remediated assets in future periods.
Thank you, John. Look, I'd like to highlight again that one of our core promises to shareholders as the investment manager of USF is that of transparency. Despite the progress that we've made on the remediation plan, it's clear that there's still work to do. And now we're facing some additional challenges related to things like theft and grid outages. We'll constantly consider the need to permanently adjust our forecasts if we believe that some of those issues become ingrained and therefore it's appropriate to do so. And with that in mind, I'd flag that within this set of reporting, we've included specific scenarios showing the impact on NAV of permanent amendments to the forecasts due to underperformance scenarios. I'll now hand it over to Dan Watson, our Head of Sustainability, to talk a little about responsible investment in relation to the USF portfolio.
Great, thank you very much, Tom. So, as an investor in solar, the company continues to support the energy transition and energy security within the US. In addition, the company recognises the importance of managing investments sustainably and aims to integrate best practice where possible. When it comes to non-financial disclosures, the company has embedded ESG data collection requirements into USF operations and management company contracts. This has been introduced as part of our aim to improve the quality and consistency of non-financial data over time. The information gathered is then processed by our internal asset management and ESG teams to deliver data aligned with the Sustainable Finance Disclosure Regulation, or SFDR, and Task Force on Climate-Related Financial Disclosures. While USF is not currently required to comply with the UK sustainability disclosure requirements, we continue to monitor evolving standards. In May 2024, the FCA introduced its new anti-greenwashing rule. And although the company is not directly in scope, the company fully supports its principles and working alongside the investment manager will continue to ensure that all disclosures accurately reflect the sustainability characteristics of the portfolio. The company's commitment to sustainability extends beyond compliance into active community engagement, among other things. Each of our project budgets include an allocation for local support, $500 annually for projects under 10 megawatts and $1,000 for projects above that threshold. During the reporting period, we donated $500 from 4 of the Heelstone projects, County Home, Fremont, Mariposa, and Son 2, amounting to $2,000. These projects are all located west of Charlotte in North Carolina and within the Hurricane Helene impact map, and they were chosen for their proximity to local communities in need. Led by John, our asset management team coordinated these contributions to support residents and key stakeholders during a challenging time, underscoring the company's belief that the benefits of renewable infrastructure must also flow directly to the communities where we operate. And with that, I'll hand back to you, Tom.
Yeah, thanks, Dan. As we discussed at the outset of the presentation, there have been significant changes made to the US energy policy. Whilst it might take some time for the market to digest and react to these changes, we are already seeing some increased interest in operational solar assets when compared to the same period last year. So when talking to the outlook for the fund, the strategy for the fund, and the market update, it's worth considering that there has been a lot of change. And assuming our views on the direction of energy prices are borne out, we'd expect to see an overall more favourable environment for the sale of the USF assets. However, we'll need to assess the implications for the wider market of the changes to energy policy before providing any specific guidance around options that may be available to shareholders. Generally speaking, we see the changes to energy policy as positive in terms of a sale, and that there may be an opportune period of time approaching where a sale could be contemplated. We've committed to the board and to shareholders to remain very active in assessing the ability to sell the assets of the company and continue to work closely with the board in order to identify the correct approach to maximise shareholder value. Now, one area that still remains to be seen off the back of the recent changes to US energy policy is the impact on state-level renewable agendas. Now, I have talked before about the importance of state-level agendas, state-level demand in terms of driving both pricing and recontracting for the USF portfolio. To our minds, state-level agendas have a greater importance than federal agendas for operational assets. Thus far, we haven't seen any changes made to state-level policies as a result of changes made at the federal level. But this will be an area that we continue to track very closely and monitor over the coming months. One of the things that could come from the change in federal policy is it could make the goals at a state level significantly harder to achieve. Now, that could result potentially in state level agendas reducing their requirement to procure renewable energy. But we also remember 2016 when the federal agenda had the opposite effect, and many states increased their state-level commitments to procure renewable energy. So we're very actively monitoring that, and we will provide updates as and when we see significant changes, either positive or negative, in those state-level agendas, and try to communicate to shareholders what we see those translating to in terms of price changes. So I really appreciate everyone's time here today. Thank you for listening to the presentation. I'll open it up to Q&A at this point and then provide some closing remarks after we've hopefully answered as many questions as possible.
Thanks very much, Tom. So the first question here, I think, is related to what you were just talking about. It says, with US policy uncertainty under the Trump administration, how do you model the potential downside risk if renewable incentives weaken further? And conversely, what upside do you see from the structurally higher merchant power prices?
It's a great question and so topical right now. What we would expect to see, and I talked about the handful of advisors that provide long-term forecasts for energy prices here in the US and indeed globally. How they do that is they have multi-factor models that they run based on updated assumptions every quarter or every 6 months. All things considered, with the reduction in things like investment tax credits and some further headwinds in terms of permitting and procurement and interconnection issues, we would generally expect to see that those models, where one of the primary factors is how many new megawatts and gigawatts will be brought onto the grid over the next 10 to 15 years, reduce. And again, all things considered, that would tend to lead to a price increase. Now, what we don't know at this point, because the majority of the changes were enacted into law in July, is exactly how those models provided by those specialist advisors will be adjusted. It may be that other factors are changed as well. It may be that the advisors have a different view on what the outlook is as a result of the changes at the federal level. But we have to think, from where we stand at the moment, that the removal of the subsidy support for development of solar and wind generation is going to have a negative effect on the number of new megawatts and gigawatts coming onto the grid, and therefore, all things considered, prices should increase. So when we're thinking about our modelling of this, we're really trying to predict and preempt where those advisors will come out and how their models will react to the changes that have been passed. Again, we will know the outcome. We will know what the updated forecasts and curves for energy prices look like by year end. We'd expect the autumn or fall forecast to be the first chance that those advisors have to really incorporate the changes to federal policy within their forecasts. And we'll be able to see at that point whether those changes impact pricing either negatively or positively.
Great. 2 questions here on time periods, I suppose. So firstly, what is the average remaining life of the assets in our portfolio? And then second, what is the average remaining PPA term? And how can we manage the recontracting risk as those contracts begin to roll off?
Yes, the average remaining life of our portfolio is around 30 years. We have a varied mix of PPAs across the portfolio, and this information is in the interim report. We have some very long-term PPAs, such as for the Milford asset, which is pretty much for its entire life. And then we have some shorter term PPAs, and the blended average of those is currently 10.4 years. What we would see happening in terms of recontracting is some of those shorter contracts. We would expect to start looking into recontracting those so that they would either extend or be renewed at the end of their current term, pretty much from today. So with what we think is going to be an environment for increasing power prices, it motivates us to put all of our assets into a position where we can go to potential off-takers, to potential buyers of the electricity, and talk to them about their own views as to where energy prices are going to land. And in those conversations, it gives us the opportunity to offer the megawatts and gigawatts that we can generate over the uncontracted period and talk to them about fixing out longer term contracts if indeed we believe that that's accretive to the portfolio. So we're really doing that for a big proportion of the portfolio from today. That will continue, and whether we strike new contracts in the next 12 months or in the next 10 years, that will be a negotiation with the off-takers. But that's very much core to our strategy and core to what John and team do on a day-to-day basis.
Thanks, Tom. A few questions about the discount, why we think it's trading at the price it is, and what discount management strategies we're employing.
We've seen the fund trade at a sustained discount from even before we took over as the manager, and I think there's a number of factors that feed into that. I'd say a lot of it is to do with macro or market factors that are affecting the entire closed-end listed investment trust space rather than specific issues with the USF portfolio. But it would be naive of me, I guess, not to point out that the USF portfolio is somewhat of an outlier. It is a UK listed fund investing solely in US renewable generation, and there's not very many peers that have that profile, and therefore there's a much shallower market for the fund, and maybe less that is known about this portfolio, and maybe more unknowns in terms of the market. One of our jobs coming in as the manager was to provide more information, specific information rather than kind of general information about what's going on in the US market, and be very deterministic and very disciplined about what we believe is affecting this portfolio as opposed to what isn't. And I think that's now hopefully very helpful as things change rapidly here in the US. And what we hope to see here is, through additional information being provided and some of these types of reporting, the interim and full year reports, but also these presentations, we can start to inform the market around what's important to the portfolio and what's changing, and maybe narrow that discount.
Thank you, Tom. John, I think this is a question for you. It's what proportion of our outage issues are related to a specific brand of solar equipment, and what kind of spare parts strategy we're seeking for replacing that equipment?
Yeah, so the spare parts strategy is specific to every brand. There's certain brands that have more spare parts available versus others. But regardless of brand, we're kind of defining the level of criticality of each part within the inverter based on cost, lead time, and impact to fund revenue or generation. To sit here and say what brand is sort of responsible for the most underperformance, there isn't a clear loser. If we were to say it like that, I think each brand has its challenges, and we've learned those challenges, and it's just navigating around those and kind of playing to it. And whether that's advanced tech certifications and training, or it's establishing better relationships with that equipment provider, we're exploring all options, and we'll continue to do so.
And just a follow-up question for you there is, do tariffs have an impact on the equipment that you're sourcing or replacing?
Tariffs are more relative to sort of development and construction assets as they're purchasing a large amount of equipment. For us, it's not purchasing equipment per se. It's more purchasing parts of the equipment. We haven't seen a great impact of tariffs to date, but it is something that we're keeping an eye on and level set kind of as we go to purchase spare parts as well as parts just needed to get things back online.
And Meredith, I think there's a follow-up question on the same topic, which I might just pick up
Please.
on here, relating to tariffs and imported equipment and the drag that might also add to new renewables development. Look, we certainly see that. That has could potentially have two impacts. One is that there's less development. The second is that prices increase. We've seen maybe a 2 to 3 cent per watt increase in panel and component prices over the last 6 months, and we would expect that would continue because of not just the tariffs, but just because of some of the protective policies that have been implemented by the new administration. I think it goes back to what John was saying there. It's a very dynamic time. I think someone has, I keep using the term, someone has given the box a really good shake, and we're waiting to see what the impact of that is. Some of those impacts we are seeing across the portfolio, and I think things like longer lead times for items and just more general dysfunction in the supply chain is a direct result of no one quite knowing what the long-term outlook looks like anymore, and therefore maybe the changes are significant enough that they're amending their business model or losing staff or gaining staff. And it's just going to take a little bit of time here to kind of work out how things fall out. But there, for us, is something of an inevitability about the major changes, the removal of investment tax credits, and the way that will play out through the market. And as I've said at the start, I think we find it difficult not to see that translating, at least in the sort of medium term, into increased prices.
Thanks, Tom. And then finally, we have a question more generally on the market. Do we think the market has an appetite for operational portfolios like the companies at the moment? And why do we think that? Have we seen comparable transactions recently, for example?
We have seen an increase in comparable transactions, certainly from a really low starting point where there was almost no comparable transactions 12, 24 months ago. And I think that's positive for the USF portfolio. I think the reasons that that's happening is that we've now got the potential for higher power prices. Buying a generating asset in a market where there's more demand for electricity and there's higher prices for electricity is a more interesting play than where demand and prices are static. And I think that's what we're seeing. The second thing that we're seeing at the moment is money flow back out of the development space. In 2021, 22 and early 2023, there was a huge amount of money being deployed into development pipelines. Now that's still happening to some extent. There are still things that need to be built, but some of the capital that we were seeing flowing in that direction has looked at operational assets as a bit more of a safe harbour. And I think that will continue. And as I said within the presentation, we need to stay very active here because there will be potentially an opportune time to go to market with this type of portfolio and to create a liquidity event.
Fantastic. I think that's all the questions.
Well, thank you all so much, and really appreciate everyone taking the time to be with us here. And there will be further opportunities to ask questions in future presentations, or if you want to reach out to Meredith, myself, or John and any of the team in the interim.
Perfect, guys. That's great. If I may just jump back in there, and thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the US Solar Fund PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.